Yeah, I'm losing my edge.
2-year yields are actually closest to their historical low. A lot more room to fall, as we're seeing today, in 10s and 30s. And so I posed the question of which is the most valuable yield from an investment standpoint. And then I put together all this data here because you can kind of see it, but it might look too small. But we're at about 20 basis points in 2 years. The historical low is 11 basis points. Now we're at about 120 basis points in 10 years, but the low in that is about 50 basis points. So right there, you can see what I'm talking about, where we've seen a big upside in 2-year yields the last couple of weeks, but still much closer to that historical low than the 10s or 30s.
Yeah, and you know what's interesting though, Frankie? You're absolutely right. Those twos, we both agree that, and it'll be interesting to see how this plays out. But with no one wanting the zero bound broken in U.S. rates, it seems to be that at 19 or 20 basis points, this seems to be it's not a safe trade, but it's an interesting trade, and it's one that's interesting. If you have a long-term view that at some point rates are going to normalize, the rates, quote unquote, normalize through the Federal Reserve. And what the Fed does is act on very short-dated instruments. And that too would be reflective of it. It's interesting though, you point out, so we are halfway away from the all-time low in twos was what, Frankie? 11 basis points?
Yeah, 0.11%.
So we're halfway from there. Now with this collapse in tens, we're close to about halfway there, not quite halfway there, but we're on a percentage basis, we have dramatically pulled back in both those. But I think we tend to look at that not as that percentage basis, but as that nominal rate right now. I mean, sure. And only I do because it's fresh in my mind, us trading a lot of 88 basis points, 90 basis points, 92 basis point 10 years and being frustrated that
sure
we never got to trade above 100 or 10 in the index until once we got it, we got a nice run up. So,
and I'm glad you bring up that piece because on a percentage basis, and we're talking about a percentage of, in theory, a percent, which is the yield, 2 years are moving the most, they've ascended the most. But like you say, Pete, on that nominal basis, they're right now at about 20 basis points. And their historical low is 11, whereas in the 10-year, they're over 100 basis points. Their historical low is 50, and 30 years, the historical low is 100 basis points. They're still hovering close to 200 basis points. So that just gives you, at the end of the day, if you wanted to be long yields, Pete, and yields moved higher in the next 6 months from here, these lows that we're hitting as we speak right now for the last several months, the 10-year and the 30-year would probably ascend to higher heights than the 2-year. But if you wanted a better value, and that's what I get into in the article there, 2 years are way closer to all-time lows. And like you say, like it's not a safe bet, like nothing is a safe bet. But when you talk about the risk-free rate for 2-year treasuries, that is one of the safer things that has historically never gone through 0% and is right now hovering about as close to 0% as it's ever gotten. So a pretty good market to look at in terms of value, and one that I would guess wouldn't have as much downside as stocks or even the 10 or 30-year yields if we do keep collapsing in some of these risk on markets. And Pete, another risk on market that I want to get you into here talking about, because this is probably the biggest mover here today.
3 days, $10? It's not a big move.
We've got crude oil here, Pete. That got
trapped all the way rats in a sinking ship. Yeah, this is
all the way up to $75, Pete. Yep. And you and I were talking about this range of like, okay, well, it went from 50 to 55 to 60 to 65 to 70 to 75, and we're just going to play the range. And the range was 70 to 75. Now, Pete, all bets are off as this market has absolutely collapsed, like you say, about $10 in the last week of trading here. What are you looking to do? I mean, I put together the 5-day forecast for all of our markets, Pete. We're cleanly through the lows for the entire week, and it's Monday afternoon. What say you on crude oil?
You know what? This is a great example of, so we want to trade that range, 75.5, 76 down to between 70 and 71. Now, you had time today to buy 70s, and it sat between like 69.90, 70, 70.5. that would not be a get out point. But once we talked about that, once they kind of traded and stayed, spent some time there, 69.70, 69.65, because the market moved relatively quickly, that no longer is in the range trade. Now, sometimes, as we talk about, the range works wonderfully for us, like it had in spree in the first half of the year. The key is when the range doesn't work, and we never know quite when that's going to be, is that we use that range as a tool to move the 50-50 probability. And once it's violated, we're capitulating without any emotional attachment to it. I traded the range. The range didn't stick this time. We got, and I don't want to say it's classic crude because it's not. A lot of times we get a great range in crude for a period of time. But you know what? 76 on the run up and the 70 range, which had previously kind of worked 2 times, completely gave way today. And you know what? The fact that it took 3 days to go $10 doesn't make, well, that range has to hold. It can't go $10 in 3 days. It's got nothing to do with time. It's always a function of price. Very rarely do my get out levels have to do with time. The only occasion when I might use time is just when a position, quote unquote, gets stale. It just doesn't do what I want to do, and I want to move on to something else. But here is an issue where we've got, and I would look at this right now, and for a short-term scalp, we have blown $5 through this range. I would look at a short-term scalp here, but we'll talk about that in the next segment. But this was a good example to, that 76 seemed, it seems so rich, and it was just 3 days ago. You know what? This has to bounce somewhere. This shows that disciplined mechanics, when your strategy is violated, the mechanics have to be disciplined and you have to manage. And if you don't right now, you would be sitting on longs that would be out $400 or $500 a contract.
And what's great about everything you just said is, Pete, this market could, and is probably more likely than not, going to bounce back at some point in the next 24 hours. Now, will it get back to 67 or 68? We'll see. But what's really nice is if you played that 70-75 range and it blew through $70 as it has in the last, few hours to maybe 24 hours of actual trading, then hopefully you took one loss on that range. And now you're free, like Pete is talking about, like we're going to do in the next segment, to play this new range and try to scalp here this week on this market getting back into this projected range, getting back at least to 67 or 68, somewhere like there. But yeah, if you got long in that $70 to $75 range, Pete, crude oil got to $70 and you got long there, and now you're just sitting on those longs, you're handicapped. You just have to wait for that market to hopefully get back. What if it gets all the way back down to $60 or ranges that we saw last year, below 50, 45, even down there? You don't want to have your hands tied, Pete, at a certain range. Same with the upside. When we were selling into these rallies, Pete, we didn't sell 60s and say, hey, I'm holding on to these short 60s until they get back here. We sold 60s, got out for a loss, and then sold 65s, tried to make up a little bit money off of that. Same thing here today. I know it seems like the sky is falling. There's probably going to be a bounce in crude oil at some point. Just don't accumulate longs, though, and tie your hands here. Get out if you're looking for $100 on the bounce, get out for $100 on the loss, because the crude oil market will likely move to a next level, and then you can get in there. Just don't handicap yourself.
Absolutely. And if you cut yourself your position of that $100, $67.80, $68 seem cheap. Now, I don't go and wait just 20 cents on the downside and rebuy them. I want to see some extent. Now, that would have been the same thing, and you would have managed them at $66.80. Now, you would have thought, how in the world can I sell that down $4.50, $5? Well, you see, we traded under $66 here. So it would have absolutely been the right thing. I could see nibbling again, but when we nibble at least a day's worth of movement at that new range. Now the question becomes, if we're going to, and we'll probably try a short-term long scalp here. If we do that, is the new range, Frankie, because we're here 65 to 70? We have no idea. The new range hasn't established itself yet. And as you said, we could continue this snowball down to $60. We don't know. It's the same mechanics and management and that we're going to try at a 3 standard deviation move for this shorter period of time and see if that works. But this was a great example of that range working for a short period of time, but very quickly giving ground. And that time has no function. If I'm a neutral range trader, time has no function in my decision making.
Well, I'm glad we'll wrap this up here because I want to get on to actually trading here in a second. But you raise the great point, which is like at a time like this, everybody is fearful and defensive and like, oh, I tried this thing. And that is for good reason. You know, VIX is up a ton and crude oil, like you say, is moving a bunch. But having those mechanics means that I'm free now to trade. Right. Like you said, this is a multi-standard deviation trade. Move lower in crude oil. I absolutely want to be in there trading it. You just have to make sure you have the right mechanics. It's not fear to the point of not doing anything because, Pete, this is the biggest sell-off in crude oil since April of last year. Like this is more than a year's worth of trading that we haven't seen, you know, a $5 down move in crude. So we absolutely want to get there and trade it. We will in a second. But last thing here, everybody's favorite segment, Pete, you need to rank our pairs trades of the week that go out to our members every single week on Monday morning. Here's what I have for you. I'll describe all 3 of them, and then you can give me 1, 2, 3 ranking of your favorite to least favorite. First up, we have crude oil against oil stocks. And this one I think still holds here that crude oil itself has been beating the hell out of energy stocks. You're seeing the downside in stocks and especially energy stocks here today. So I once again, I think this still holds a 1 SMO to 100 shares of XLE basis there. You could also take a look at a short SMO contract against 1 or 2 puts in XLE, but you at this point with the big down. Oh, although the XL, I was going to say a big down move in SMO, so I don't know if you want to be selling into it, but I mean, that being said, obviously going to be a pretty similar big down move in XLE. And we all know what happens to stock options to the downside. That's where a ton of the premium goes. So I wouldn't mind actually looking at maybe selling a bounce in SMO and selling some puts in XLE, or at very least, maybe just looking to sell some puts in XLE. That could be a good one to look at. You can deconstruct these however you want, but yeah, 1 SMO contract is about 100 shares of XLE. Second one, Pete, we have, and we're seeing it play out again today to the tune of $2. Tech stocks are outperforming all of the rest of the stock market. And it makes sense, right? Because a lot of the fear is going into energy stocks and industrial stocks, stocks that could be knocked around by these renewed fears on the pandemic. But that being said, this has been a great one for back and forth, selling tech stocks when they outperform like this, buying maybe the SM75 or the Russell or something like that. Very intriguing pair that I know you've liked to look at recently. Last one, Pete, and I don't know if you would have thought that this one would be coming, and this is another one that's moving in your favor if you want to look at the price extreme. The TUT spread is getting back to being relevant again from a long 10-year, short 2 years side, Pete. We had those 2 years jump up and they've stood pat at those higher levels. The 10-year giving away a lot of ground. So if you want to go with a steepener, you could sell that 2 year, buy the 10-year on a 1-to-1 basis. There you go, Pete. You have your 3 pairs. Let's rank them.
They're fantastic. Sticks SM75. You got to go back at 600 points here. You got to like the trade. $2 is, I've got to imagine 2.5 times the daily range there. The trade sets up really nicely. Sure, it's a big down day, but again, if we go back and look at the dailies, it's a correction and of relative proportion here. But I think this is a place where the shifting back and forth continues to occur. We're not at a point where everything is just really unwinding, and this trade continues to work. So I think this one works for us. It's moved to a nice level here. It's at 600 points. Definitely want to put that one on. The steepener, you got to argue if you think rates are going to go, you want to be, I mean, at 120 basis points, you want to be, you want to be long some tens here. And I think, so you've got 2 ways to be long tens. Long tens and short 2s or long tens and short 30s. I honestly think that I would rather be long the tens and short the twos. I don't know what I do though with my long twos. That's the problem. Am I just taking them off for a period of time to be long tens? And you could argue that for a scalp here.
Yeah.
It bothers me that these rates where yields are falling again as we go into the afternoon here. I would have thought we would have held up a little bit better here, but tends to be yields look, when they look their worst, they turn. I mean, we thought the 155, 148 was the tradable level. We're well through that. Now, I don't know what the new tradable level is. Is it 120 to 150? I don't know. But for the 30 basis points of extreme, I like this. So I think buy the tens, sell the twos. The SMO is, again, I can't sell a $9 3-day break. I get where you're going with the trade.
Sure.
And this would be one where if you rallied $3 in crude, $3.50 in crude, and you would think, well, I'm still selling the market $7 or $6 lower than where it was 2 days ago. You put something like XLE against it, and that becomes a really nice trade. That way you feel like I'm trading, a $3 bounce, which is a solid bounce, and adding a little bit something against it. So I would have to wait on that. Sticks SM75 I go to right now, and the tens seem like a solid scalp. I want to make sure that I get my twos back because I do love owning my twos. So there you go.
Awesome, Pete. Thanks so much for doing that. That will conclude our Monday edition here of Small Stakes. We'll be right back with Splash into Futures. A ton of stuff to do here in the futures market. So stick around, everybody. We're going to have plenty of trade ideas. Thanks for watching.